morning, everyone. Welcome to Dyke Yaxley's 2021 budget briefing. My name is Francesca Hutchison, and I'm the tax director here at Dyke Yaxley. And this morning I'll be chairing our roundup of yesterday's announcements. We really are delighted that so many of you could join us today in Shropshire and further afield, from your kitchens and your home offices and wherever else that you may be working in lockdown 3.0. Looking at the numbers, I think we're well over 120 already this morning, so that's a fantastic turnout, especially since there's no free breakfast on offer today. So what are we planning to cover in the next hour or so? I'm going to start by introducing you to my co-presenters, Mark Bramall and Matt Orange, and then I'll also run through some housekeeping for this morning's webinar. I'll then move on to cover the economic update and the tax changes, of which there were not many, thankfully, but they definitely made up for their lack of numbers in their magnitude, before handing over to Mark, who will run through some of the coronavirus business support measures and the funding that's still available to businesses during the pandemic. Mark will then share his experience of making successful funding applications and how to optimise funding across a wide range of sources, including internal working capital management. And then finally, Matt will bring us up to date in the VAT space, looking at some of the complexities of cross-border trading in a post-Brexit world, as well as covering the domestic reverse charge for construction businesses, which finally came into force this week after a 12-month reprieve. At the end of the session, the three of us are going to take questions, which you can post to the panel using the Q&A function within Zoom. So to start with then, let's meet the panel for today. So, in true daily briefing style, joining me to my right, we have MEB, not JVT, so that's my fellow director, Mark Bramall. Mark heads up our business development team at DY and supports a wide range of corporate finance and fundraising activity for our client base. Mark works with a wide range of traditional lenders, as well as some of the newer crowdfunding and lending platforms, and he also sits on the National Corporate Finance Network. And then to my left, we have the very witty, but not Chris Witty, Matt Orange. Matt is a client manager in our corporate team with a passion for VAT and who's been supporting our client base over the last few months as they get to grips with cross-border trading in a post-transition world. And so for the first of my many next slides, please, this morning. Housekeeping. Working hard behind the scenes today, we've got our marketing team, Jackie and Mel, who've helped to pull together today's presentation, and they will be on hand today throughout to log your questions and comments as they come through. And in true Jackie Weaver style, we will not tolerate any bad behaviour this morning. So in place of Jackie Weaver, we've got our very own Jackie Young. She'll act as moderator, and I can assure you that she has the full authority to kick you off the webinar if necessary, although I'm sure that won't be the case. And so before we get into the detail, I thought I'd better check that everyone can see the slides and can read the text. So if you want to take the infamous Barnard Castle eye test before we start. And then finally, before we get into the detail of today's presentation, if you do have any technical difficulties whilst we're speaking, you can note these in the chat box and Jackie and Mel will do their best to help you. If we lose connection for any reason, then the webinar is being recorded today and we'll be able to share a link with you to view this again after the event. And as I mentioned at the start, if you have got any questions, if you want to post those in the Q&A box rather than the chat function, and that will make it easier for us to see those as we're going through the presentation today. We did try and get a Shropshire exclusive by getting Rishi to join us today, but unfortunately he was trapped by his cat filter, so you'll just have to make do with the three of us. So let's crack on then with today's presentation. Setting the scene. If you've been to one of my budget presentations before, then you'll know that I always like to start off by looking back over the last 12 months and taking stock of what's gone on in the world and in the world of tax over the last 12 months. Well, 2020. I'm not sure that I even know where to start with that. And in all honesty, we could probably spend the whole the whole of the next hour, if not the whole of the next week, trying to make sense of the year that was. So instead, I'll just try and capture it in a few slides instead before we move on to look at what was in the budget yesterday. So if we think back to budget 2020 as a starting point, then it's really hard to believe that this was last year's budget breakfast and it wasn't even 12 months ago. The idea that we could all be in the same room together, standing next to each other, presenting without wearing masks, having cups of tea, standing shoulder to shoulder, it really couldn't feel more alien right now. And although a huge amount of uncertainty remains at the moment, we have to hope that by the time we come to host the next budget update, that we will be able to get together in some form again. 12 months ago, those of us of a certain age would only associate Zoom with a brightly coloured lollipop full of additives and full of sugar. However, in the space of a year, we've all embraced remote working in a way that will no doubt go on to transform the way that we work in the post-pandemic business world. Over the last 12 months, the markets have remained largely resilient, despite a large drop in March last year. They've gradually recovered since then, and the pound remains strong despite the end of the Brexit transition period. But who could have forecast that the year's hottest commodities would be Bitcoin and bog roll? I think Mark's gone a slide ahead, but you'll get the gist. The new normal, we've got queues at the ports, queues at the borders, queues at the testing centres, queues at the supermarkets. It's what the British are renowned for doing, and we do it very well, better than anyone else in the world, apparently, if reputation's to be believed, and we've been doing a lot of it this past year. So without doubt, there have been winners and losers in 2020. Take online retail, for example, versus high street traders, online streaming versus performing arts, Brewdog versus Wetherspoons, a number of examples of winners and losers in the current situation. Although some would argue that there are only ever winners and winners, it's just the system that is rigged. And although 2020 has brought us together in many ways, it's also showed up some clear divides in society. Little game here, hands up if you're a COVID hero. So we've got everyone's favourite fundraising centenarian, Captain Tom, who sadly passed away last month. We've got Dolly Parton, who funded US vaccine research substantially. We've got Joe Wicks, kept the nation moving during lockdown, the working mums lockdown pin-up. And then we've got Marcus Rashford, footballer turned campaigner, who has tirelessly lobbied the government to provide free school meals to low-income families during the pandemic. And of course, every pantomime needs a villain. Now you see him and now you don't, because he was never there, honestly. And then finally, 2020 has required us to all pull together in ways in which we never have done before. They say never work with children or animals, but this last year has required us all to juggle working, running a business, caring, homeschooling, parenting, all against a backdrop of ever-changing rules and regulations and uncertainty. And I think it's fair to say that the challenge of 2020 and even going into 2021 has been immense. So speaking personally, our Dyke Yaxley team, some of whom are on the screen there, have shown fantastic resilience in delivering in some really challenging circumstances. And that, I'm sure, is the same for many of you and your own businesses and organisations and your staff. And really, I think our children are the most resilient ones of all. And it looks like the future of DY certainly will be safe in the hands of some of these young apprentices. So moving on then to look at the tax changes. A little bit of an economic update yesterday from Rishi. I mean, the level of debt that this country has now is phenomenal. We shouldn't underestimate the cost of the coronavirus pandemic. Over 2 years, the figure yesterday was around sort of £400 billion that was cited. And also, it's not only the debt, I think it's the government cash flow that we need to be aware of as well. There's a lot of receipts that have been deferred, payments that have been deferred as well. So at the moment, I think it's hard to really ascertain the state of the government finances, although it was really positive to hear that there are indications of growth, certainly for this year and the next 2 years from the Office of Budget Responsibility. And we have to hope that once the lockdown gradually unwinds and we reopen again, that actually we'll see some recovery in some of the key market sectors in the economy. Outlook for inflation and interest rates remains uncertain, and I think that will be one of the key factors that will influence future government tax policy decisions, because it won't take much of a rise in either interest or inflation for the cost of the government borrowing to increase significantly, and I'll come on to that a little bit later. If we think about the global stage as well, things are still very fresh and raw in terms of the end of the Brexit transition period, and I know certainly our clients are still trying to get to grips with what that will mean for them in practical terms. There are still tensions with China and the Far East, so the global stage is far from uncertain as well. I think the key question that we have to ask, and the Chancellor must have been asking as well, is are tax increases the right response, and are they the right response now as well? So I appreciate this slide may be hard for you to see, but I've lifted this from some of the government statistics that were published in mid-February. That rectangle to the left there is graphic representation of the total tax receipts by the government in 2019-20. So that's the pre-pandemic year, the last year of the old normal, if you like. And within that, there's three taxes which are protected, loosely protected, I would say, by a triple lock mechanism. So December 2019, the Conservative manifesto said, we will not increase income tax, VAT or national insurance in the course of the next Parliament. Arguably, December 2019 was a different world and a different era, and I think that many people would understand if the government had to go back on that promise, but governments don't like making or breaking manifesto pledges. So if you look at that graph there, the triple lock taxes, they account for more than 57% of the total tax receipts in 2019-20. So that's a huge amount of income that's effectively, that has restrictions hanging over it in terms of what can or can't be done in terms of tax rises. So really the next biggest figures within there perhaps are corporation tax, which accounts for 6% of the government's receipts, and capital taxes, which always attract a lot of headlines when there's talk of them being tinkered with, but in reality, that's inheritance tax, capital gains tax together, they're accounting for less than 4% of government receipts. So even substantial changes in those spheres wouldn't actually generate a significant amount in terms of tax revenue. If you just click again, Mark, just going back to what I said in the earlier slide, a 1% rise in inflation and interest rates would increase government borrowing by 25 billion. That's figures that Rishi was banding about in the papers over the weekend. So to put that into context, a 1% rise in corporation tax would raise 3 billion. So it's inevitable that further tax rises are going to come. Obviously, I think the scene was set for that yesterday, but that gives you an idea for some of sort of the magnitude of the changes and the importance that where we go with interest rates and inflation is going to have on future tax policy. So policy decisions, it's looking likely that we're going to see incremental increases to a number of taxes now over a period of time, but the harder question is obviously by how much. As I say, we're going to be heavily beholden to inflation and interest rates. And there was talk yesterday of building us back up to effectively having a fighting fund to be able to deal with whatever may be around the corner in future. Although you would like to think that we could return to a period of stability, hopefully, for some time yet, but it would be good to be prepared for what may be in store in future. Policy decisions, online taxation is a difficult area. I think many people were expecting to see almost winners and losers being picked in the sphere of, do you tax online businesses over high street businesses? We were expecting to see a lot around sort of carbon-based and green taxation. And there's obviously policy decisions to be made in terms of looking at excess profits and potentially wealth taxes, given the current economic climate, and also the general awareness that a lot of people and a lot of better off people have managed to save a lot more during the pandemic. So they've done disproportionately better out of the current situation. So what we knew already, this is a very long slide. we have probably the most media savvy Chancellor, certainly that I can recall in my lifetime and my working lifetime. Rishi has very strong media relations and a very strong social media presence, and it's become apparent that most of the points in yesterday's budget had been released in some form well in advance of yesterday's statement. So by yesterday lunchtime, we already knew that there would be an extension of the coronavirus job retention scheme. So that's the furlough scheme. We'd already had the Buy Your Boozer initiative, the community funding, matched funding initiative to help support pubs, clubs, venues in community areas, help to grow the management training for SMEs. That was already on the radar. Recovery package for sports, in particular cricket and football, support for the arts, high street, further funding for vaccinations. All of these things on this list here, we knew in advance of the statement. So really, it was a case of what was going to be dropped in that we didn't know, and of that there were two biggies, I think, and we'll come on to those later. So what we were expecting. I think if you'd have asked me what we were expecting when the budget was announced before Christmas, I would have said capital gains tax rises, I would have said a reform of inheritance tax, and possibly increasing corporation tax. But that was pre-lockdown 2, and obviously we're now still in lockdown 3. So the closer we got to the budget, I think a lot of people in the tax profession, their thoughts on where Rishi would go with tax policy and tax changes had also changed to reflect the current circumstances. So I think, yes, it was likely that corporation tax rates were going to rise. Sorry, can we go back to the previous slide? Yeah, it was likely that corporation tax rates were going to rise. We were expecting an extension of the stamp duty land tax relief, just purely on the back of the volume of transactions that we were seeing, and that our property agent contacts have been seeing trying to complete in this last month of the old regime. I had one eye on potentially the withdrawal of higher rate pension tax relief, but that's survived another budget. That's one that often is cited as an easy way of targeting higher earners and those with substantial savings, and it would be quite an easy one to withdraw, I think, and increase revenues in that area, but certainly that's survived for now. Capital taxes, I was expecting to see a bit more on the back of the Office for Tax Simplification reviews of capital gains tax and inheritance tax, but really there was very little in either of those areas. But I think we were all expecting that there would be a nod towards further tax increases further down the line, and I think the shape of yesterday's statement has certainly positioned us for that. Next slide, please. So what did we get? Big borrowing, big spending, big taxing, and big plans, but no changes to capital taxes despite all of that speculation. So I'll just run through each of the taxes now, each of the main taxes, and just summarise what we saw, what changes there were, just to keep you up to date. So income tax, no breach of that triple lock pledge, but we're having a freezing of the bands until 2026. So I think it would be fair to say that that's an indirect tax increase for many, because although he's limited in terms of raising the rates, actually by raising the threshold up, by freezing the thresholds and not adjusting these for inflation, arguably the tax take from income tax should increase then in future, and that's quite a long time to freeze those bands for. Similarly, the pension lifetime allowance is frozen until 2026. So yeah, it comes back to that fiscal lag. As wages go up, then take-home pay is effectively going to decrease disproportionately for taxpayers. Savings income, the 0% band remains unchanged at £5,000, and there have been no changes to ISA limits, including junior ISA and child trust fund allowances. So sticking with personal tax, national living wage is increasing to £8.91 from April this year. It's nice to see that there's an extension of the support for the self-employed and that those grants will continue until September. I remember they are taxable grants. There is a cap on them and it's based on previously declared and taxed profits. So up until yesterday, the newly self-employed at the start of the coronavirus pandemic had largely been excluded from any form of support from the government over the last 12 months. But it was pleasing to hear that there will be some targeted support now for those who have filed a tax return by midnight on Tuesday, and they will now be eligible, if they filed a tax return for the first time, then they'll be eligible for some form of support under these last 4th and 5th grants for the self-employed. There is, however, a nod to the fact that some people will be doing better out of coronavirus than others. So the measures are going to be even more targeted, in as much as unless your turnover has dropped substantially, you won't be eligible for the full amount of that support. So employment taxes, again, no surprise here really that the furlough scheme is being extended, and I think many people have been calling for certainty around that for some time. Interesting, however, that this has been extended to September 2021, and I don't know whether this is the cynic in me, but you know, if all lockdown measures are intended to be eased by mid-June, then the Chancellor is still providing business support through to the end of September. Suggests to me that there may be the timeline that we all seem to have become fixated on over the last couple of weeks may actually be adjusted at some point, depending on what happens with these new variants. However, with the furlough, employers are going to pay higher contributions to help sort of match fund the government support for employees who aren't working their full hours. So employers will be asked to contribute 10% of the cost in July, moving up to 20% of the cost in August and September. Not a lot announced in the sphere of share schemes, although there was a nod given to a consultation being announced on enterprise management incentive schemes. So that's a form of tax advantage share option for high growth companies and sort of high flying individuals within those companies. So it'd be interesting to see what comes out of that, because that's very often a tool that we see used with our high growth but perhaps cash strapped or cash limited businesses as a way of locking in and retaining and rewarding key individuals. So it'd be interesting to see what's announced and what shape the consultation takes with regards to that. On national insurance, we've had the primary threshold rising a little bit up to 9.5 grand, but the upper earnings limit matches the new higher rate band in line with income tax. And then that upper earnings limit is then fixed just as the income tax is. So again, another example of that fiscal lag. On the positive side, there is doubling the incentive payments for new apprentice hires. There's a whole raft of policy measures in terms of traineeships and apprenticeships to sort of support young people, and some of these policies are not age restricted, so it's to support people returning to the workplace and embarking on new careers. Business rates, I think that's a hugely topical one, certainly in our geographical area as well, and it was pleasing to see that the business rates holiday has effectively been extended by 3 months, so that takes us through to the end of June this year. The remaining 9 months of the financial year business rates will be discounted for up to 2/3 for closed businesses, although there will be a lower cap for businesses that have managed to remain open in some form during the current lockdowns. However, I think it's fair to say that just business rates, furlough, and some of the other wider grants that are available, they may not even cover the fixed costs for many businesses. So whether that will be sufficient to help the high street survive remains to be seen. And I think there's many retailers who will be calling for additional support measures over and above the grants that were announced yesterday as well, to help them navigate the rest of a challenging year. So corporate taxes, this is where it gets meaty, and this is where there was a big announcement yesterday. So The headline tax rate is going to increase to 25% from its current rate of 19%, and that will take effect from 2023. So effectively, we've got a 2-year grace period leading up to this substantial 6 percentage point increase. Now, that headline main rate is going to apply to taxable profits over £250,000. There will still be a small profits rate up to £50,000, and that rate will remain at the current corporation tax rate of 19%. And then in between, we're going to see a tapered rate. So I'm working out that would be about 26.5% for profits between that £50,000 and £250,000 mark. For those of you who've been around in practice for as long as I have, then small company profits rate and marginal rates is nothing new. We've had it previously. Personally, it's a very, very complicated regime, more complicated than perhaps policy intended it to be, and it led to a big drive towards profit manipulation and profit smoothing. So it will be interesting to see whether those points are taken into account when we see how this new marginal rate in between is intended to operate. Another positive for companies who are struggling at the moment was the extension of tax loss relief. So there's now going to be a 2-year period where companies can carry back their tax losses up to 3 years and effectively get a tax repayment of corporation tax that they may have suffered in previous years. So obviously there's a cash flow trade-off there. If you're carrying forward your losses, you'll be potentially getting tax relief at a rate of 25% if they're going to unwind in future, whereas you could effectively cash in now and have the cash back at 19% that you may have paid in the past 3 years. So really that will depend on how much cash you need within your business and how well your business is doing at the moment. And I think an effective cash flow forecasting model is required to work out what's best in terms of cashing in now or effectively having any losses unwind in future. We may well see reduced rates of corporation tax for businesses in these new free ports. 8 new free ports in England were announced yesterday, and if they operate like in enterprise zones did in the 90s, then we may see that businesses operating in those zones may be able to benefit from a reduced rate of corporation tax, which may be one of the planning strategies for some businesses in terms of mitigating that 25% tax rate from 2023. Also in line with the Enterprise Management Incentive Scheme consultation, there was also consultation announced on reviewing the existing R&D regime to make the UK attractive for inward investments. So there were no noises made to suggest that it would be a consultation with a view to limiting the scope of this hugely valuable tax relief. But again, just as with the EMI scheme, it's going to be really interesting to see what comes out of that. So VAT and duties, I won't tread on Matt's toes too much here, but again, just to say no breach of the triple lock pledge. The VAT registration threshold will be frozen until 2024. As we expected, hospitality and leisure will continue to benefit from a reduced rate, and that will be extended until the end of September. So again, in line with the date for the end of the furlough scheme now. They will then benefit from an interim rate of 12.5% for 6 months before going back to the standard rate from April 2022. And with regards to duties, all planned increases in alcohol and fuel duties have been scrapped as well. So a few other business measures that are probably worth noting. Help to Grow training scheme for SMEs. That is twofold. So there will be an executive management training programme for high growth SMEs where they can benefit from government funded places on training and development courses. And there will also be a matched funding sort of voucher scheme to help small businesses develop their digital skills through investment in software. There was also a nod towards visa reforms and making it easier for highly skilled workers to come to the UK, potentially without a sponsoring employer, and also a simplified process for SMEs looking to recruit overseas employees and bring them to the UK. So on to capital taxes. I was expecting to have more to talk about here, I have to say. So capital gains tax exemption, inheritance tax, nil rate ban, they are frozen until 2026, and no other changes to CGT or IHT. So entrepreneurs relief, now known by its snappy title of business asset disposal relief, that survives another budget. So even on the back of the Office for Tax Simplification reviews of IHT and CGT in July 2019 and November of last year, and even against a Wealth Tax Commission or Stealth Tax Commission report, which came out just before Christmas, we've had no substantial changes, no changes of any note in the capital taxes regime, which is really interesting. And I would keep an eye on that, certainly ahead of a potential autumn budget. Now, at this juncture, I thought I'd better check whether you're all still awake. So a quick game of odd one out from Have I Got News For You? So Mark, if you could just click so we can see the... Right, so hands up if you know who the odd one out there is. We've got Nigel Lawson, Gordon Brown, George Osborne and Alistair Darling. Okay, so the odd one out there is Nigel Lawson. He was the last Chancellor to try and bring capital gains tax in line with income tax rates, which is what the Office for Tax Simplification have concluded would be sensible in their report that came out last year. So all the other Chancellors there have introduced measures which have increased the differential between capital and income tax rates, whether that was the introduction of taper relief, entrepreneurs relief, or extensions to holdover. So that's a snappy fact for you. And then the next odd one out. So we've got Spain, the UK, Switzerland and Norway. And the odd one out there is the UK. All three of the other countries have some form of wealth tax. So although the concept sounds almost alien to us in terms of taxing increases in wealth rather than transactional driven taxes, it's not out of the realms of possibility, given that some of our close neighbours have some form of wealth tax as well within their jurisdictions. So watch this space. Capital allowances. So I think corporation tax increase and the capital allowances super deduction are the two biggies from yesterday's budget. But the two biggies, and that they will certainly impact big businesses more than smaller SMEs. So this new capital allowances initiative is effectively a 130% super deduction on qualifying investment in plant and machinery, and that will come in for the next 2 years. Now we see these super deductions in a number of other tax reliefs that we work with. We have the research and development super deduction, and we also have a super deduction for qualifying land remediation relief, so cleanup costs for contaminated land. And what the government is doing is effectively subsidising corporate investment in capital expenditure, qualifying capital expenditure. So whatever you spend, you get a disproportionate amount of tax relief back in the form of this super deduction on your investment. And what that does will accelerate your tax relief over the annual investment allowance, and you will get an additional 30% uplift on your qualifying investment. Now, if I'm being sceptical, will we see manufacturers reflecting this in the cost of plant and machinery that they're selling to consumers who could benefit from this? Potentially. And also, are we storing up a problem in terms of corporation tax terms further down the line? Because obviously when we get the capital allowances, we are saving corporation tax and we'll get a huge deduction in year one. But going forward, as those are, as the depreciation unwinds through the accounts and we add that back for corporation tax purposes, are we going to end up in a position where we're actually then paying a bit more tax at a rate of 25%? So we'll have to wait and see. On that super deduction, it will apply to most expenditure that would otherwise get relief at 18%. So that is your big kit, it's plant and machinery, it is tooling, it's equipment. It's not going to be the fabric of buildings. It's not going to be sort of electrical installations, lighting, the things that form part and parcel of a property. But what it's designed to do is encourage some businesses that will be sitting on investment decisions to actually take risks and spend money and effectively spend our way out of the deficit. So I'm sure for many businesses it will be welcome news. I think the share price of BT increased by about 7% yesterday on the news of this announcement, because they have a capital expenditure budget, I think, in substantial capital expenditure budget over the next couple of years for the rollout of fibre broadband. So these are the businesses that are going to benefit. It's manufacturing, construction, utilities. It's going to be businesses with a high asset base. With tax avoidance and penalties, there isn't a budget that comes in that doesn't have more anti-avoidance measures and kind of tinkering around the edges. Yesterday it was announced that there will be a substantial £100 million investment in tackling tax avoidance within the UK, and that will manifest itself in a new task force with over 1,000 investigators who will be tackling perceived fraud in some of the coronavirus support measures. Also in the small print in the Treasury papers yesterday, there's going to be some reform coming in to the penalty regime to align penalties for income tax and VAT initially. So I would expect that then to roll out across other taxes. This isn't anything new. I think it was first put forward in about 2018 and introduction was delayed until 2021. But it looks like we're going ahead with that now. So it will make it even more important that taxpayers are computing and paying and filing on time to avoid these tax-geared late payment penalties. Green measures. Chancellor's announced a new infrastructure bank that will be based in Leeds. That's going to have an initial capitalisation of 12 billion, but looking to support around 40 billion of future funding. A new retail savings product to support green projects, but if that's linked to current national savings and investments rates, then whether that will be enough to encourage savers to move their money into a product like that, possibly not. We've had policies around further increased investment in offshore wind, and an updated monetary policy remit reflecting the government's commitment to get to a net zero carbon position. And then finally, a regional focus. I always like to sort of ask, what was in the budget for Shropshire, and certainly Shropshire and our wider Telford and Wrekin, Mid Wales sort of client base. Arguably not a lot yesterday, I have to say. It would be fair to say that there was a red wall bias, I think, for a lot of the regional measures that came in. We've got the new Treasury campus that will be situated in Darlington, the infrastructure bank, as I mentioned, that will be in Leeds. Of the 8 new free ports in England, Wolverhampton was sort of the closest to our patch, if you like, and we'll have to wait and see sort of what that entails in terms of cheaper customs duties and tax breaks. The new town deals, again, they really don't sort of come onto our core geographical patch. I think again the closest one there was Wolverhampton, although perhaps of interest to some of our rural communities would be the community funding initiative, the Buy Your Boozer that I mentioned at the start, which will hopefully support theatres, pubs and shops that may otherwise be lost from rural communities by going into community ownership. As always, the devil is in the detail. A few things that I picked up from going through the fine print late last night. mention of plastic packaging tax, which will come in from April 2022, and that will apply to consumers, producers and business users. The exemption for home office expenses is extended to 5th of April 2022, but that doesn't make clear whether the flat £6 a week allowance is extended for the full next tax year. Making tax digital, that will be extended to small businesses from April 2022. There's been no reprieve for IR35 and the changes that will impact contractors working in the private sector for large end users. Those changes will still come in next month. The R&D cap for SMEs, we knew about that, but that's all in the detail. The new PAYE based repayment cap will come in for accounting periods starting on or after the 1st of April next year. So there'll be some decisions to be made for smaller businesses, smaller startups claiming R&D relief, and they will need to think about their remuneration planning for owner managers who may previously have been on a largely dividend only remuneration package, but actually it may be more beneficial to increase their overall PAYE contribution to facilitate a larger R&D repayment. And then another key date, I think, from the calendar, it's noted that a range of tax consultations will be announced on the 23rd of March. So the scope of what that will cover and the taxes that are reviewed will be very interesting to see, because I think that will shape where future policy decision is going to go in terms of an autumn budget. So that just about wraps up whistle-stop tour of 2020, economic update and tax changes coming from the budget yesterday. I'm now going to hand over to Mark, and he is going to talk to you about some of the coronavirus business support measures and also give some practical insight into how you can structure your financing and your working capital management to take best advantage of these schemes. Before I hand over, if you've got any tax questions, again, pop them in the Q&A, and then we will pick those up at the end when the three of us take questions at the end. Thank you very much.
Thanks, Francesca. Good morning, everybody. This side of the presentation is fairly brief, as we didn't have a huge amount of excitement coming out in terms of really what businesses probably need at the moment. So the sort of big announcements had been leaked with regards to some grants to help the high street, hopefully getting some of our non-essential retail back on their feet, and also supporting leisure, hospitality, personal care and gyms with grants of up to £18,000. Again, as Francesca said, probably not a huge amount really, or sufficient to keep some businesses going, sadly. So the support is limited there. So in terms of the finance aspect, obviously we've got bounce back loans and coronavirus business interruption loan schemes, which have been very popular over the last 12 months. There's no extension to this scheme. So the reminder is that the closing date for this is 31st of March. And then there's going to be a new recovery loan scheme in their place. And this is for loans or overdrafts, asset finance, invoice finance, ranging from 25,000 up to 10 million per business. The applications, we're told, will open from 6th of April right through to the end of this calendar year, 31st of December. So this one is going to be also government guarantees up to 80%. However, I would expect there to be personal guarantees potentially at least for the 20%. So it will be different to the existing loan schemes that are in place, and the business will be paying fees or interest right from the beginning of any finance facility they put in place. And really a forewarning is that it will be assessed on the affordability, probably a combination of pre-COVID trading and then what the business is looking like going forward. So probably with some form of restructure, reassessment of the market, etc. So businesses will need certainly projections, I would imagine, for these new loans. The insolvency measures, this is sort of a preempted slide, although no announcement came yesterday. Currently, there's insolvency protection for businesses, and there was a leak in the middle of February which suggested this was going to run through till the end of March next year. It's not ideal if you're owed money. If you're a landlord with a commercial client not paying the rent, very little you can do to force their hand at the moment. But if you are one of those businesses that is suffering, there is a stay of execution or protection for you. I would just urge people to keep an eye on that one, because once the rules are lifted, then there could be a surge of challenges on people who are not paying their bills on time. So given that there was very little really to come out that was going to make a big difference to businesses, we thought it would be handy just to touch on what's available locally. And big thank you to Emma Chapman from the Marches Growth Hub, who was able to just give us an overview of probably what we view as the most relevant grants and popular grants within the Shropshire and Marches area. So we've got a couple of programs just to mention here. We've got the Business Growth Programme to sort of build supply chains, stimulate innovation and growth, and looking at the sort of levels, the typical business to business loans or grants will be sort of from 2,500 up to $1 million. They are generally linked to job creation, and they will support businesses within the Marches LEP. And I'm sure we can pass anybody's details on to Emma if you want to discuss further how you access these grants. So there's still the Marches Building Investment Grant. So this is helping businesses who really want to own their own premises, or certainly occupy their own premises for a longer period. They will support costs up to 50% of the project, maximum 150,000, but a very generous grant if you're looking at enhancing or taking on an old building and bringing it back into use. Then there's some smaller sort of grants available, just helping businesses with grants up to £10,000 on capital equipment. Again, looking at for job creation, boosting productivity, improving the efficiency within a business. And as you'll see there, you do need to create at least one part-time job within a 6-month application of the grant. And it does exclude a couple of sectors as well there, unfortunately, restaurants and hotels. So just to pick up a bit more on what we do have in place in terms of the finance, I thought it'd be useful just to touch on bounce back loans. For anybody who has not accessed a bounce back loan, or perhaps sees that they may need some cash injection in their business in the next few months, a reminder that the bounce back loan scheme will close on the 31st of March, and it's based on up to 25% of turnover, typically for 2019. The loan maximum is 50,000. It's all completed online with generally your existing bank. For businesses that have only taken up a small proportion of this loan, as a reminder, you can actually do a top up now up to the maximum that you're eligible for. The interest rates are very, very good, 2.5%. The loan is completely unsecured. So if you run a limited company, it's not lodging a debenture or taking personal guarantees. However, if you're self-employed or running a partnership, just bear in mind that personal debt still stands with you. So it's not quite as separate as it would be if you were running a limited company. But yeah, 31st of March for that one. The terms now have been extended slightly. So originally people were taking these loans, they were for a 12-month interest-free and capital-free period. And now you can take that loan up to a 10-year period, almost paying as you grow. And if you are struggling to make the repayments when the loan is due to commence payments, then you can ask for an additional 6-month repayment holiday, but you will need to pay the interest for that period. So the CBILS, or Coronavirus Business Interruption Loan Scheme, this is for the businesses that require loans in excess of 50,000 and up to 5 million. And this also will close on the 31st of March this year. Again, it's based on a maximum of 25% of turnover, will be assessed on affordability based on predominantly your 2019 results, but also probably looking at the business now or in its forward looking guise. the arrangement fees on that one and interest are again covered by the government for the first 12 months. So there's no repayments initially, capital or interest, for 12 months. The rates do vary from lender to lender. The terms at the moment predominantly are 6 years, which is 12 months of no repayments, and then paying the balance of the loan over 5 years. And that's for loans and asset finance. And then in addition to that, we've got supporting government guarantees for overdrafts and invoice finance, which are for a 3-year scheme. So I suppose when we're looking at the businesses at the moment where there's a mixture of requirements within the business, it's important to just look at what you can do within your own business in conjunction with external finance. Many clients who have taken on the debt have obviously not taken the decision lightly to take on these loans. It wasn't their choice to have the coronavirus hit the UK, and so obviously taking on the debt is something that's got to be repaid. There was a lot of talk yesterday how the loans were still due to be repaid, and the new scheme that's coming in is not going to be a great help if those businesses see little prospect of their business returning during the course of this year. So it's important that businesses are on top of working capital, managing their stock levels. This is incredibly difficult at the moment for clients who are bringing goods in from overseas, because they're having to probably order more. There's long lead times, paying more up front, cost of goods have gone up. But it's really important that you are on top of your stock holdings and understand if you're carrying stuff that you can turn it into cash as quickly as possible. But equally looking for alternative suppliers. Perhaps there's some that will give you a shorter lead time, and that will mean less cash tied up. Important to monitor your customer payment terms, looking at making sure they stick to their terms, and then perhaps where you've had a shift in what you have to pay to your suppliers, you perhaps need to realign your customer profile terms and think about whether you need to get more payment up on order or when delivery is taken, just to improve your own cash flow. And just generally managing your own customer debts, keeping on top of the credit collection. I appreciate that with the insolvency measures that we have at the moment, it's difficult to take action against businesses, but you still need to be managing the situation carefully and looking after your own debts. And in terms of other ways of unlocking cash, businesses are seeing growth despite the pandemic. They may be able to access cash through an invoice finance facility, which is something they've not had before. It could be utilised through the CBILS scheme, so they get some guarantee, which makes sure you get a good release of cash into the business. And then there's looking at the tax side of things. We've been working with businesses that help them get their R&D claims in. That's a cash injection potentially. If you sell back losses, don't forget looking at earlier years R&D claims. You can go back and bring back a couple of years worth of claims. That could be a good cash injection for the business. And then the final one, really, hopefully there's no one from the revenue on the call today, but having a good arrangement with HMRC. They've been very, very supportive of the businesses that we've been working with and helping get arrangements. So Matt will cover the VAT position, but just generally all of the taxes, in fairness to HMRC, they've been very good at putting in monthly payment plans, typically up to 12 months in some cases. They're very accommodating and understanding. It's just going forward with a sensible plan is the important thing. If you've got significant debts of 150, 200,000 up and upwards and looking for a longer period than 12 months, we would suggest that requires a written plan with a proposal, projections and so on, because there will be some businesses coming out of this pandemic that just are not in a position to start repaying HMRC at the moment. So the negotiation won't be as straightforward as a few phone calls, but we've been helping clients with all sizes of debts. So it's an important area to remember. So in terms of what we've been doing over the last 12 months, personally, I've been involved with CBILS Loans for clients raising over 5 million now. Typically, those loans have been less than 250,000, as many clients don't want to give personal guarantees. Worked with a whole range of lenders, all of the mainstream banks, alternative lenders, secondary tier lenders, and it's interesting seeing the mix of terms. So you need to be mindful of what's important to your business. Some lenders will assess it purely on the 2019 figures as to whether you're affordable for the loan. We've seen other lenders who won't allow part repayment on the CBILS loans. So if you're thinking we'd like to pay some of it back early, but not necessarily all, it might be just something to be mindful of when you're applying for these loans. And in terms of how we look at funding, and this has been the case prior to the pandemic really, but just to highlight, when we're talking to businesses, it is really thinking about a blend of finance and where they get source of cash moved from, and it's about being as efficient as possible. So we work with a company that was running a sole trader business alongside each other, and from year to year profits are jumping all over the place, losses one year and the other. So we've sat down and really tried to look at making sure that the businesses are running as they should be. And in the beginning of the pandemic, they rightly applied for bounce back loans. They didn't know what was on the cards for them, so they had a cash injection. As it's turned out, they've had quite a good year, so they're able to optimize utilizing that cash, plan some capital expenditure. So we've looked at where they're buying their assets to offset that against profits in the current year. They're looking at R&D claims for 2 years plus a current year, so they'll be able to do a combination of some cash injection by reclaiming R&D, but also utilizing the R&D against profits going forward. And given that we know that there's a tax hike coming, we will probably defer more of that R&D claim into later years, so we get better relief for it in future years by carrying the losses forward. And in terms of making this all very efficient, what we've helped the client do is get more money out of the business, is help them settle private mortgages and make overpayments on a commercial mortgage which was outside of the company. So overall, they've got their finances in order, but by a very good mix of looking at everything. It isn't all a one solution, and that's what we can do with you, is sit down and make sure we optimize everything with you. So that's me. The finance, there's lots of different ways of doing this. So I'll hand you over to Matt, who will touch on some of the VAT points that are relevant to us at the moment. It's a huge area, so hopefully Matt's not going to cover it all, but just highlight a few of the key planning points. So I'll hand you over to Matt now. Thank you.
Thank you very much, Mark, and good morning, everybody. I'm going to present a VAT update, as it is currently a very topical area with a huge amount of changes going on at the moment. And I'll start off by looking at the deferred VAT. So last year, right back during the very first lockdown, businesses were given the option to defer the payments of VAT that fell due between the 20th of March and the 30th of June. And when the policy was first implemented, it was stated that the deferred VAT would have to be paid to HMRC by the end of March 2021. And then later on, they announced that they were going to introduce a new scheme where businesses could repay it in installments. So now we're in March 2021. Businesses that haven't paid or either the full amount or still have some of the deferred VAT left to pay, there's essentially three options available. So the first one is to pay the full amount that is due by the end of this month. They can agree a time to pay arrangement with HMRC, and if businesses wish to do this, they have to make sure it's in place no later than the end of June. And then the third option is to join this new VAT deferral payment scheme. There is one question I have had a few times is, it's just people have said to me, well, when are HMRC going to collect this payment? Because they may have an existing direct debit and that's how they normally pay their VAT. And the answer is HMRC will not automatically collect this deferred VAT. You do have to do one of the three measures that I've mentioned. And then the other point as well is that they have also said that if a business hasn't paid it, got a time to pay arrangement or joined the new VAT deferral scheme, then any amount that is outstanding on the 30th of June, there will be a 5% penalty level levied on this amount. So the scheme, the new payment deferral scheme, has opened up. It was last Tuesday on the 23rd of February, and it is open for applications up to the 21st of June this year. During this period, the amount that's owed is interest-free, and businesses can choose to pay it back over up to 11 monthly instalments, which will be paid by direct debit, but it can be in as few as 2 instalments. So you can see on the screen that there's a table there which kind of shows that the longer businesses leave to join the scheme, the fewer number of instalments that they will have available. So there is a kind of action point here that if businesses do want to get the most out of this scheme and have the 11 instalments, you've only really got 2 weeks to join this scheme and apply to use it. It is applied for online at gov.uk through the page which refers to paying the deferred VAT. You'll need a government gateway account to do this. There are some conditions to joining the scheme, one of which is that all VAT returns for the last 4 years must have been submitted. Agents are not able to do this on behalf of clients, and when you join the scheme, the first instalment is due at that point. So really, the message is that for any businesses that have yet to pay the deferred VAT, we should not be looking now at how they're going to pay this over to HMRC. Next slide, please, Mark. This is arguably the most topical area at the moment, although it may get overtaken by the reverse charge for CIS. But it is a couple of months now since the end of the transition period. And my role generally sees me dealing with quite a wide variety of post-Brexit, both VAT and customs issues, really. So what I wanted to do was share some of the more frequently asked questions or issues that seem to be arising. And the top of the list for me definitely is deferred VAT versus postponed VAT accounting. Now the terms that seem to be used quite interchangeably at the moment, but they are very different. Deferred VAT existed before Brexit, postponed VAT, okay, it existed in the 1980s, but it's back again now. And the normal way when you import something is you expect to pay the VAT as the goods are coming across the border, and then we're going to assume that the business in this example is entitled to reclaim the VAT. They'll get their C79 from HMRC, and then they will reclaim this on the next VAT return. If you defer it, rather than paying it at the border as it comes into the country, you will need to have a duty deferment account set up, unless your agent allows you to use theirs. It will then be collected by direct debit on the 15th of the month following when the goods were imported. And then again, you'll get your C79 and claim it back on the VAT return. Now, postponed VAT accounting you don't end up paying it at all in this example using the trader that's entitled to claim it back. What will happen is you ask your agent, or rather you instruct your agent that you wish to use to postpone VAT accounting, and when they submit the import declaration, they make entries on the declaration, which means that the payment doesn't become due. And then that will get processed in HMRC's system, and it will generate or populate a online monthly statement, which can be downloaded. And they're meant to come available at some point during the month after the import has taken place. They're accessed, these statements, via the postponed. You generally have to go onto the gov.uk website. We have tested this very recently, because if you just log in using your normal government gateway, you won't see them. You need to access the link that's on the postponed VAT account statement page. Then you log in with your government gateway details, and then it will show you all the statements. The January ones are available. We have seen them when we recently logged in. The February ones weren't available yet, but it is only a few days into March. And then you will see those statements, but it also says on there that those statements are only available for 6 months. So it's key that you go in and you start downloading these statements as soon as they become available. There is no formal application needed to HMRC to use postponed VAT accounting. That's another thing where it's different from deferred VAT, because you need a deferment account, a due deferment account, if you're going to use deferred VAT, and that can involve having a guarantee or applying for a waiver. None of that is needed with postponed VAT accounting. It is very, very straightforward once you get into it, but there have been teething issues, certainly with getting some agents to use it. Some customs agents are automatically using it, to be honest. I've seen correspondence where they're just saying that we're going to use this, it's in your benefit, we will use it, it's a cash flow boost, unless you tell us not to. Others, on the other hand, you do have to push a bit more and say, no, we would like to use postponed VAT accounting. And then the other issue that comes up with this one quite frequently is how do I account for it in software? If you're better using Sage or QuickBooks or Xero or whatever, really, and just using Xero as an example here, because this is one that I use quite a lot, is what they have done is when you go to prepare the VAT return, you bring it up in Xero, down by the button where it says submit to HMRC, there is a link which says enter PVA amounts or something along those lines, and when you click on it, it brings up a screen where you take the amount that's written on these online statements and you put it into Xero, and then that will automatically populate all the boxes. So the software is generally getting up to speed with that. Not all. There are some issues with some of them, but generally speaking, a couple of months into it now, the first VAT returns are generally due now, so they are getting on top of it. Rules of origin. This is quite a big area, really, with a lot of concern. Plenty of news stories covering this. I think the Percy Pig Marks and Spencer one is one of the biggest ones that I can recall off the top of my head. But the deal we have with the European Union covers goods moving to and from the United Kingdom and the EU that originate in the other party. So if we have, for example, goods that are coming from, let's say, somewhere like China to the United Kingdom, and there's going to be duties if there's no trade, or any country where there's no trade deal or preferential rate, then we will have duty due as the goods enter the UK. Now, when those goods, if nothing happens to those goods and they're sold or moved from the UK to the EU, then they're not deemed to originate from the UK. And this is where these rules of origin are causing some issues, because strictly speaking, it would be a situation where duty could end up due on those goods again. I'm not going to go into too much detail on ways that could be mitigated, but generally you're looking at things like customs warehousing, temporary admission, if they're available in those kind of situations. There are some quotas as well. So the European Union doesn't allow unlimited amount of certain types of goods to come in, even if there's a trade deal in place, to go into the European Union free of duty. So that's another thing to watch out for. Checking trading terms. This is it was more, I think, as in the build to Brexit, but I still see it quite a bit in basically it's looking at what your Incoterms are, both when you're buying from the European Union or anywhere really, and selling to your customers in the European Union. Now, if you're selling on what we call DDP, that's delivered duty paid, when those goods enter the European Union, you generally become responsible for dealing both with the import declaration as they enter the European Union, and then you also become responsible for any local taxes, any duty or VAT that needs to be paid at that point as well. So from there, businesses may find that triggers a requirement to register for VAT in the European Union. And then it also, a lot of European Union countries, because we're now classed as a non-EU member, they're saying, well, for non-EU members, no, you need a fiscal representative as well. So it's definitely something to watch out for, because there's a lot of hidden compliance costs which can kind of appear from trading on DDB terms. The other one I get quite a bit is VAT numbers. Do we still need the VAT numbers of our EU customers to zero rate the goods when we're selling goods business to business in the EU? And the answer is no. It's the same as trading with anyone now outside of the United Kingdom or the rest of the world as it was before. We needed the VAT number before because it was classed as an intercommunity movement, a dispatch or an acquisition, depending on which way the goods were going. The VAT number we needed, we put it on our EC sales list, and off it went, and it was we could zero rate the supply. What we need now, rather than a VAT number, is proof of export. That is the big thing. If you're zero rating because you've exported goods from the United Kingdom, the big thing you'll need is proof that those goods have left the United Kingdom and they have to be exported within time limits as well. And that time limit for most things is 3 months. But I would say for VAT numbers, I've just covered goods, but for services, I would recommend that you do still keep the VAT number, or you get your VAT number for your customers in the EU, especially when you've got your business to business. Your VAT number is proof that you're selling to a business customer. There are other forms available, but the VAT number is one of the easiest to get hold of usually. And then finally, the Brexit queries, the other one I hear quite a bit is, well, when we used to buy stuff from overseas suppliers, when we used to buy overseas services, I should say, we'd reverse charge them if they were bought from somebody in the EU. Do we still do this? The answer is yes. Yes, you do still apply the reverse charge on services which are purchased from an overseas supplier, unless they're exempt, something like insurance. And that applies to any country in the world. It always did before, but for some reason it was mainly referred to as an EU thing, but it wasn't. It was something that applies to any country outside the United Kingdom. Next slide, please, Mark. So the final thing I'm going to cover from a VAT perspective is the other issues. It's what's happening now and things that are coming up. It's not a long period really over the next few months. 3 days ago now, we had the reverse charge for CAS has started, and the big thing I'm encountering here at the moment is everybody is needing to figure out where they are sitting in the chain, really, whether it's your customer or your subbies. You need to kind of know where you sit in this chain first before you start thinking, well, what are we charging? Are we charging VAT? Because once you figure that out, most of the time you'll get the answers that you need. And this is coming from many companies are already doing it. You'll start seeing letters, especially if you're involved. They're sending letters out, and they're asking, generally it's 3 questions. It's, are you VAT registered? Are you CIS registered? And then the big one, which is coming up and causing quite challenging a lot of the time, is this end user or intermediary as well. But when we're looking at the end user, we are, strictly speaking, it's the end user of the construction services. It isn't the end user of the property, if a property is being constructed, if of course the two are different. It's all about looking at what is the onward supply, or our onward supply, from a VAT perspective. So if we're having a property constructed, a commercial property constructed, and then once we own it, once it's built, and then we're selling it once the construction's completed, our onward supply is likely to be one of land and property from a VAT perspective, not of construction services. So we become the end user. So really, if you're involved or you think you're affected by this, you need to start asking your customers, are you VAT registered, CIS registered, and are you an end user? And then to your subcontractors, you need to be telling them, look, especially if they usually charge you your VAT, you need to be saying, yes, we're VAT registered, yes, we're CIS registered, and then you need to figure out whether you are the end user and let them know. What HMRC have advised in their technical guide is suppliers can include a clause or a line or sending something out by email or letter and really just send to your customers a statement which says, look, we're going to assume that you are the end user unless you tell us otherwise, because if they are the end user, you'll just continue charging them VAT like you used to. And they've said that's fine, because that puts the onus on the customer then to turn around and go, well, hang on a minute, no, we're not an end user, these new rules do apply. So a lot of challenges in this area at the moment, only 3 days into it, but yeah, I can see this one going on for some considerable amount of time. The next thing that's due from the end of the month, or rather from the first VAT accounting period that starts after the 1st of April, is the digital links have got to be required for Making Tax Digital. When Making Tax Digital was first introduced a couple of years ago, there was a soft landing period for these, and then they were extended again, mainly because of coronavirus, but now they are due. And it's really, there's got to be links so that the transfer of data between your programs or applications, that has to be done digitally. And then the final one, which is not a UK one, but it's going to affect a lot of UK businesses, or any business outside the EU, to be fair, is there are reforms to the e-commerce and the mini one-stop shop. The mini one-stop shop, to be fair, it isn't really going to be a mini one-stop shop anymore. They're getting broadened to cover all business to consumer supplies of services. So that's definitely one that's going to encompass more and more UK, or any business outside the EU is going to have to consider whether they need to be using the one-stop shop, as it will be known then. And then at the same time, there is an introduction of what's called the import one-stop shop, which will mainly affect retail sales of goods with a value of less than 150 euros that are being sent in or sold from into the European Union. There are similar rules that were introduced in the UK, albeit so we use the value of £135. They came in from the 1st of January, and there were quite a few news reports at the time, news articles at the time, which stated that some EU companies had ceased delivering to UK addresses because it meant that they had to register for UK VAT. And of course, you've got additional compliance costs in there. So it's definitely one that businesses need to be aware of. It's currently scheduled in for the 1st of July, but one thing to be aware of is it was originally from the 1st of January. It's got deferred to the 1st of July. Will it happen on that date? At the moment, it's still planned to, but time will tell. And that's the VAT area. Thank you very much.
Thank you, Matt, and thank you, Mark. Really useful roundups there of funding and VAT. We're going to take some questions now. I've got a note of these, and I'll field them out between the various presenters. Firstly, nice to know that somebody out there is listening and awake. So thank you for spotting the deliberate error in my slides. Of course, East Midlands Airport is our nearest free port. That's the joys of homeschooling 3 children and trying to pull together your budget slides in one afternoon and get World Book Day costumes together. So thank you for spotting that. Your prize is in the post. But yeah, Wolverhampton will benefit from the new town plan, and East Midlands Airport is the nearest free port to our core sort of geographical patch. Looking at one of the tax queries that's come in, the Help to Grow scheme is only eligible for companies. Is that fair? I throw a question back, I guess, in response to that. Is tax policy ever fair? I think there needs to be some control mechanism over how these reliefs are administered, and eligibility is monitored, and funds are distributed. There are quite a few tax reliefs out there, quite a few of the more generous tax reliefs that are only available to companies, R&D and land remediation relief being 2 of them. It doesn't surprise me that there's a restriction that limits the Help to Grow funding to companies. I think often that's a sign of a larger, more ambitious corporate vehicle, although there are many other structures that a business may take. But unfortunately, yes, for the moment, Help to Grow is company only. And indeed, that's the first field that potential applicants will come across in the application process, is to enter their company number. We've had a question in, Matt, if I can field that to you, on the reduced rate of VAT for hospitality and leisure. And we've had a question as to what that actually covers in terms of supplies.
Okay, so the reduced rate of VAT affects supplies are in the hospitality, holiday accommodation and certain attractions. Now, the main things that applies to is catering services, hot takeaway food, holiday and hotel accommodation, and then admission only to certain attractions. Theme parks are included, so things like theatres and museums. Of course, if they've already got the cultural exemption, then that will apply. So although it has been given a broad title of hospitality, holiday accommodation and attractions, it does only affect a limited number of supplies.
Thank you, Matt. Mark, one for you. We've had a question as to what grants are available for development of commercial property on undeveloped land.
So the March's Building Investment Grant may be eligible. I saw the question crop up and Emma has kindly replied, but it will apply to new builds, potentially. It's important that the business is business to business in terms of its customer base, and obviously looking at job creation. A couple of other relevant points linked to sort of new building developments is that if it's undeveloped land, then it's unlikely to be contaminated. But if it was contaminated land, as Francesca touched on, there is enhanced tax reliefs for companies that undertake that work. So you get a 50% uplift in expenditure of putting land straight or clean. And then also, if you're doing a building and you've got a fit out of the integral features, the sanitary, plumbing, lighting, aircon, alarms, etc., all of those things can potentially be put into a capital allowances claim. So you get a tax deduction for those, which can be quite a significant part of the build and often underestimated when companies look to fit out, or businesses look to fit out their properties. So certainly worth speaking to somebody prior to undertaking those works, so that you get the information pulled out at the front end of the project, which can make the claims much easier to incorporate within your tax returns.
Brilliant, thank you, Mark. We've had another question on the tax side. There've been rumours that there may be some relief coming in for directors of limited companies who may largely have been on a sort of a heavily skewed dividend versus salary remuneration package, and limited support available in terms of the grants and furlough, etc., for directors of limited companies. And the question has been asked as to how that will influence future remuneration planning, and should directors of limited companies be going more onto a larger salary. I'd say we very much like to review remuneration planning on a client by client basis. It's very difficult to have a one size fits all solution, but no doubt the substantial increase in corporation tax from 2023 onwards is going to have some bearing on remuneration planning, because if all other things remain unchanged with regard to dividend taxation, etc., then skewing more income towards salary and getting a greater corporation tax saving in the business, if your business is large and has profits of more than 250,000, then that may be advantageous. But I think we need some time to run the calculations and also look at people's individual circumstances and business profitability as well. So that's one to keep a watching eye on, but certainly recommend to all clients as you approach the end of each tax year to review your remuneration plan for the current and also the forthcoming tax year. So now is certainly the ideal time to be doing that, and myself and members of the tax team here at DY would be more than happy to speak to people about that. So I'm conscious of time, and I know there's a couple of questions that we haven't had a chance to cover, but perhaps if we can email those participants individually on their questions. That allows us to sort of to try and wrap up within our allotted time slot. So Mark, if you, next slide, please. If we look at budget 2021, then in the round, then who were the winners and losers? Arguably, winners include the self-employed who've not previously been eligible for any form of support. They will be delighted to have some form of support between now and September. SMEs who have lower rates of corporation tax and additional training and support. So those businesses with profits up to the 50,000 mark will continue to benefit from the 19% corporation tax rate and potential uplift on investment in capital expenditure. Again, capital intensive businesses, so construction, manufacturing, we have a lot of those in the West Midlands, and they should do very well from the new super deduction for investment in qualifying plant and machinery. And also big winners would be vendors who didn't get deals over the line by budget day, of which I know there were quite a few. Losers, arguably, all those accountants and lawyers and corporate financiers who were working all hours over the last few weeks to try and complete deals before March in anticipation of capital gains tax changes, who will probably be burnt out and worn out and wishing that they'd left things to complete throughout the rest of March. But sort of joking aside, the losers would be really middle income earners, those people who are going to be squeezed by the freezing of the income tax spans, and who are going to see their earnings decrease disproportionately as those bands are frozen through to 2026. And larger, more profitable companies, particularly those who are less asset intensive or less driven by innovation, who will see their profits decrease due to the increase in corporation tax rates going forward, in the absence of the availability of any of the other sort of allowances that we've touched on today. And I think really it's all eyes on an autumn budget. I think typically the budget would have been held in October, November time last year. It was cancelled and we had a spring budget instead. But in normal times, I would expect us to return to an autumn budget. So whether on the back of these consultations that are coming out later this month, we'll see a return to the autumn budget and more substantial tax changes then. Certainly I've been encouraging anybody whose transaction didn't complete this week to make sure it's definitely completed ahead of an autumn budget. So hopefully that gives people enough time. So really, just to summarise then, the key messages from Mark, Matt and myself then on the final slide. Stay updated, keep in touch with us, sign up to our marketing emails, follow us on LinkedIn. Anything that's relevant we'll be putting out and sharing with people over the coming days and weeks. Control your cash flow. Now is the time to be taking stock of your finances, looking at whether you're eligible for any of the new grants, and whether now is the time to get one of the CBILS applications in before that scheme closes, and really make sure that you have that fighting fund ready for the next few years. And save tax. There are still plenty of opportunities where you can make sure that your tax affairs are structured as efficiently as possible. We've touched on some of them today, but if you want to speak to us in any more detail about any of those, then please get in touch. Our contact details are on the next slide, and we'll be circulating a copy of the slides to all people who've attended. We'll also be making a recording available if you want to watch any of this back or follow up on any of the points that we've discussed today. But really, it remains for me to thank you all for attending. I hope you and your families stay well over the next few months, and I hope that it won't be long before we're all able to meet up again in person. So thank you very much for your time today, and I hope you enjoy the rest of your day.